This video, I'm going to talk about C corporation. C corporation is regarded as a person entity is separated from its shareholder or owner for their income tax purpose. So we all know C corporation for most publicly traded company, they are C corporation. Like Google, Amazon, Tesla, all those companies are C corporation. So they basically, all the owners, so if you buy a stock of that company, so you are the shareholder, are the owners of the company. So, but you are not liable for any, if the company go bankrupt, the maximum you can lose is, the amount you bought the share, right? So they will not go after you for, the corporation borrowed all the debt or the corporation incurred any liabilities. So this is, it's a C corporation. So you are the shareholder, the owner is separate from the business, right? So that's something. In addition, the earning of or the profits from the business are taxed the regular corporation at the special corporate income tax rate. So also this C corporation is called a double taxation. So distribution of the profit in the form of the dividends are then taxed again at the taxable income to the recipient, right? So qualified dividend at the shareholder level are taxed at a lower rate. Long-term capital gain 0%, 15%, 20%, and the non-qualified dividend are taxed ordinary income. So most dividend taxpayers receive are qualified dividends. Okay, here the basically we say C corporation is double taxation. What does that mean? So basically say, let's just say you buy Apple stocks, right? Apple company, as a company, they have a income, revenue, expense. Revenue minus all the expense, you get the net earnings. They have to pay income tax on those net earnings. So then after net earnings, so then they want to distribute dividend to you. So when you receive the dividend, you are taxed on the dividend again. So most of the time those dividends are qualified dividends. So basically you have to satisfy for the holding period. So most of the time they are qualified dividends. They are taxed at the long-term capital gain rate, which is relatively lower than the ordinary income tax rate. So that's just something about the double taxation of C corporation. So for you buy a stock of this publicly traded company, you don't feel it. But if, let's say, if you want to open a business, you want to open a C corporation, let's say you open a C corporation this year, then you made a profit. You made all the incomes minus the expense, you get profit $100,000. Then you have to pay tax 21% on this $100,000 income tax at the corporate level. Then you only get $100,000 after tax. You only get $79,000, right? $79,000. Then you have to include in those in your income. Then you pay tax on those distribution to you as well. So that's why it's double taxation. So you can kind of pay on top of the corporate tax. So that's why it's a separate entity, double taxation. So here I'm just so you can see the good thing is about C corporation is anything incurred in the C corporation is within the company. So it's not gonna go after you to for the liability incurred in the corporation. So it's limited liability. Then any other things that important about deduction is the dividend received deduction. So it's one thing is about C corporation. If C corporation on another corporation receive dividends, those dividends actually allow deduction. So let's see dividends from domestic corporations. So you own a corporation, then you receive another corporation dividends. Say if you receiving corporations owns less than 20% of the distribution of the corporation, then the receiving corporation may deduct 50% of the dividends. So basically, if you own, the corporation who distribute the dividend to you, if you own less than 20%, so you can deduct 50% of dividends on the tax return. So then if you own more than 20%, you actually can deduct 65% of the dividend received, which is great. So you can use the corporation to invest. So that's why a lot of corporations buy another corporation, so kind of invest your cash holdings, right? So corporation cannot take a deduction for the dividend received a real estate investment trust. So this one just keep in mind, there's actually a list of the corporation they cannot own. So one very common one is REITs. So basically, if you are C corporation, you want the dividend deduction, you should not own a REITs because the REITs cannot be deducted the dividend. So that's something you need to know. So that's a summary of it. C corporation, we're gonna summarize something I haven't talked about in this video, but you can find it in other videos. So C corporation is double taxation, limited liability. So you file form is 1120. You file the form, then you issue dividend 1099. This is to the shareholder. So the corporation subject to 21% tax rate. Then we just talk about the dividends received deduction. So we talk about the 50%, 65% deduction. Then another thing is called special taxes. So as a C corporation, you may subject to accumulated earning tax. So this I talk about in another video, so you can watch that. So what is this say? Well, if you accumulated earning is more than business need, let's say they give a limit is $250,000. If more than $250,000, you cannot explain why you accumulated. They're gonna tax you on the 20% over 250. And if you are the personal service corporation, like accounting firm, a law firm, of doctor office, if you have your business as a corporation, you accumulate earning more than $150,000, you have to explain why you accumulated. If you cannot explain it, you are subject to accumulated earning tax. So this is very, very big helpful. So when you form a C corporation, so the personal holding company tax. So this one basically say, well, if you just form a C corporation to put a bunch of investment, vehicle in it to accumulate, investment earnings, so you are not distributed, you just hold it, avoid tax. In that situation, you are subject to personal holding company tax 20% on the amount you hold it. So yeah. Then another thing is for small C corporation, those two types of stocks is very beneficial. So one is Section 1244 stocks. So basically for C corp less than million. So if you own those stock, if you lost the money, so you can deduct those losses up to $100,000 as an ordinary loss. So basically you can offset your salary income, your portfolio investment income, your rental income, whatever other income you can offset. So that's for losses. Then for the gain, you are eligible for long-term capital gain rate if it's you hold more than a year. So that's the beneficial for the 1244 stock. Then Section 1202 stock is, say, for corporation less than 50 million. So if you bought the stock at a regional issue, so if this stock, the company took off, the value when the, gain significantly, so you actually can exclude 100% of the gain up to 10 million or 10 times of the basis. So that's about Section 1202 stocks. So the